Good afternoon, ladies and gentlemen, and welcome to today's 1031 Exchange webinar. I'm going to be your host. My name is Leonard Spoto, and today's webinar is 1031 Exchange Advanced Strategies. So we run a series of exchanges all month long, and we typically start off the month with a basic 1031 exchange class, and then as the month goes on, we advance into more advanced topics. So today is an overview of kind of more the advanced issues that we see in the 1031 exchange world. Again, my name is Leonard Spoto, and I'm going to be your host today. I'm one of the owners of Asset Exchange Company. Before we get started with today's webinar, I do have a few announcements to make. So first announcement, everybody who attends this webinar is going to get a copy of all of the presentation material. We also record the webinars and then we post them to our YouTube page so that you guys can take a look at the webinars later, or you can share the presentation with your colleagues or your clients if they were unable to attend today. And then the second thing I wanted to let you guys know is you have the ability to ask questions during the course of today's webinar. So if you have a question or a comment that you want to make, all you need to do is type it in, and your question will pop up on my computer screen, and then I will answer all questions as they are appropriate. So if you ask me a question at the beginning of the class on a topic that I'm going to end talking about, I'm probably not going to answer your question right away. So there will be questions you ask that we will get to throughout the course of the presentation, and I'll try to kind of make sure that I'm answering questions appropriately. And then the third and final thing I want to let you guys know is that I have a 6-year-old and a 9-year-old, and we started homeschooling last week. And at any point in time, my 6 or 9-year-old may pop in here, start screaming and doing a dance. If that happens, please remain calm. I will put the webinar on mute and I will pick the kid up and throw him out of my office. All right? So I think most of you are in the same boat. If you have small kids, we're kind of dealing with a new reality when it comes to work, and very often, especially my 6-year-old, he likes to come in and make a lot of noise. So hopefully that doesn't happen today. All right, ladies and gentlemen, let's go ahead and get started. So 1031 exchanges require a 1031 exchange accommodator. And that's what my company is. We do not sell real estate. We do not buy real estate. We do not provide escrow services, and we do not sell title insurance. The only thing that we do is facilitate 1031 exchanges. And a lot of people don't understand our role. So first of all, my role as an exchange company is required. You cannot do a 1031 exchange without working with a neutral third party to facilitate the process. So you have to work with an exchange accommodator, and we do 3 very important things. Number 1, we're going to hold all of the sale proceeds. When you do a 1031 exchange, you cannot be in constructive receipt of your sale proceeds. That means if you touch the money, you're paying taxes. In fact, I had a guy today call me up and he said, "Hey, Leonard, is it too late for me to do an exchange? I closed last week, but I haven't touched the money." I said, "Where did the money go?" And he said, "Well, they sent me a check, but I haven't cashed it." Sorry, buddy. If you've already closed escrow, you can't do an exchange, all right? The escrow company has recorded the transaction. They have probably withheld the 3.3% for the state of California, and they cut you a check. If they've done those things, you can't do an exchange. You need to get your exchange account set up prior to the close of escrow, and we will instruct the escrow company to wire all the funds to us. We'll set up a separate account for you, just like your IRA and your 401k custodians do, and then we will be the custodian of those funds until you go out and buy replacement property. So very important, whether it's $30 or $30 million, you can't touch the money. It needs to come to an exchange account. Number 2, we are going to prepare all of the legal required documentation to properly document the transaction as a 1031 exchange. And right on cue, ladies and gentlemen, my 6-year-old just came into my office, so I'm going to shoo him out of here. Get out. Get out. All right. And number 3, we are going to make sure that you are in compliance with all of the rules and regulations for Section 1031. And this is important because you don't want to have an audit and have your exchange disqualified, or worse yet, have an auditor determine that you committed tax fraud and you end up in jail. All right. And this does happen. All right. So this absolutely happens, and people do end up being audited. And there was actually a pretty famous case here in California where a realtor did an exchange and the government found that she committed tax fraud and she served 13 months in jail. So what we want to do is we want to make sure all of our clients are in compliance with all the rules and regulations, and they're always changing. All right. So it is very important that you work with a company that is doing these on a regular basis, not some attorney that does one or two a year. You want to work with a legitimate company and make sure that your exchange is going to be handled appropriately. All right, so that's a little bit about us. We were established in 2006, so we've been doing this for 14 years as Asset Exchange Company, although I'm one of the owners, and I have been in the business for about 20 years. Our company is bonded and insured. We have a tax attorney on staff who is a member of both the California Board of Accountancy and the California State Bar. And we do provide all of our clients with free audit support. So we'll help you out if you do get audited by the IRS or the Franchise Tax Board. All right. So let's talk 1031. 1031 has been called the single greatest wealth building tool available to investors. And why has it been called that? Well, because it is a piece of the tax code that allows you to defer the capital gains tax on the sale of your investment or business use property. Now, why is that a big deal? Well, it's a big deal because if you don't do an exchange, about 33% of your gain goes to the government. So if you just cash out of your property, decide not to exchange, you're going to face a 33% effective tax rate. Now, it could be a little bit less, could be a little bit more, depending on where you're at in your income levels. But on average, my clients have about a 33% tax rate to pay. Now, in California, for a lot of my clients, that can be $200,000, $300,000, $400,000 in taxes. I routinely see investors who are facing six-figure tax liabilities if they decide not to exchange. So when you do the exchange, the reason why people think this is such a great wealth building tool is because that money that would have gone to the government stays in your pocket. You don't have to pay that tax bill. You get to keep that money, use it for your next real estate deal, and build wealth with money that would have gone to pay taxes. All right? So the reasons for considering a 1031 exchange are pretty clear cut, but let's go over some of the most common reasons why my investors are doing exchanges. Now, as I mentioned, most people think just purely in the tax bill. They say, well, geez, I'm doing an exchange because I don't want that 33% or 1/3 of my profit to go to the government, right? So you get to defer the taxes, but really what you're doing, as I mentioned earlier, is you're using money that would have gone to pay taxes to build your real estate portfolio. So if you were looking to build wealth in real estate, you don't want to sell property and have 1/3 of your money go to the government. You want to put that money towards your next project, right? You want to put it into your next investment. So you're using the 1031 to buy more property than you would have otherwise been able to do. Now, some of my clients already own a lot of property. They're very wealthy and they own a ton of real estate. People who are very wealthy and have a ton of property, excuse me, those people are using 1031 to diversify, to protect and preserve their wealth. Now, as a real estate owner who's very wealthy, you may want to go into different geographies or different asset classes or both to achieve some diversification. I'm sitting here in Northern California right now, and I'm looking outside my window, and all I see is smoke. And a lot of my property owners, if they own property in this area, they might be thinking, well, geez, maybe it's time to get out of the California market where we're so prone to wildfires and earthquakes, and maybe we get into a different geography. And you use the 1031 exchange to trade up your portfolio without paying taxes. All right, and then the last thing has to do with time. All right, and two things happen over time. Number one, you get sick and tired of managing property, and number two, your property becomes fully depreciated. Okay, both of those are great reasons to consider an exchange. Imagine if you're a 75, 80-year-old investor. You've been managing property for your whole life. You might want to spend more time with your grandkids now and less time with your tenants. Okay, you do a 1031 exchange, you get out of your tough to manage properties and you trade into properties that you don't have to manage. Those type of properties, maybe they're triple net leased Walgreens, where you simply own the building and anything that happens to it, the window breaks, the toilet breaks, Walgreens has to take care of it. You don't have to lift a finger. All right. So a lot of our investors are looking to make their life easier by getting out of properties that are tough to manage and into something that's just quite frankly, just a lot easier to manage. And then over time, when you own investment property, you depreciate that property, but the problem is the depreciation on a residential income property will go away. After how long? Well, it goes away after 27 and a half years. So if you've owned your property for 28 years, guess what? You don't get that write-off of depreciation anymore. And I've had clients tell me that the only reason they are doing the exchange is to get rid of their fully depreciated property and get into a new, larger property where they can take new depreciation schedules. And depreciation is a write-off, right? So very good reasons to consider an exchange. And the reason why I talk about these reasons is because these are things that will motivate your clients to do deals. All right. So when you are looking at having conversations with your investor client base, some of these issues will come up, and they are very good reasons to consider a 1031 exchange. But of course, most people, they just look at the numbers and they say, well, geez, I'm going to do an exchange because I know I'm going to sell my property, and I just don't want to pay that $250,000 tax bill to the government. Now, as I mentioned, the tax rate is about 33%. And the way I got that number is by combining both the federal and the state taxes. So let's break it down and take a look at just the federal taxes. So when we sell real estate, the federal government charges us a capital gains tax of either 15 or 20%, depending on your income. There's also a tax on the amount of depreciation that you take, and that's a 25% tax rate. And then there's a final tax that kicks in for people who earn higher incomes, and that is a Medicare tax of 3.8%. Now, ladies and gentlemen, that is just the federal government, so Uncle Sam takes these taxes. And then we also have our state tax, and I'm here in California, so I'm going to talk about California taxes, which start at about 9.3 and increase depending on your income. So when you average out all of those tax rates that I just showed you, you have an effective blended rate of about 33%. Now, many of you might be thinking, well, geez, Leonard, 33% of what? Well, 33% of your gain. And and it is important for you guys to understand how much gain is in your property. And gain is simply a function of your net sale price minus your basis. Okay, that is going to give you your gain. Of course, that begs the question, though, well, geez, Leonard, what the heck is my basis? Basis is pretty simple. You're going to take your purchase price, you're going to take out your depreciation, and you're going to add back capital improvements to get your basis. So let's go ahead and do a quick example. Now, I bought a property many years ago for $500,000. I've taken a total of $100,000 of depreciation throughout the total ownership period. I put a new roof on, and that was a capital improvement of $25,000. And then I sold my property for a net sale price of $1 million. And let me tell you how I got that, ladies and gentlemen. I actually got into contract for $1.1 million, but I paid $100,000 in commission and closing costs. So my net sale price is $1 million. All right. So is your net sale price when we're looking at these numbers. All right. So what we're going to do is we're going to take these facts regarding my recent transaction, and we're just going to do some third grade math. All right. So let's take a look at our third grade calculations here. First thing we're going to do is we're going to figure out our basis by taking our purchase price, subtracting out our depreciation, and adding back in our capital improvements to get our basis of $425. And if we sell our property for anything above $425, we have gain. And in this case, we sold for a net sale price of $1 million, so we have $575,000 of gain. Now, what's my tax rate going to be? Well, it's going to be about 33%, right? But what the CPA is going to do is he or she is going to crunch all of those numbers. They're going to say, well, geez, we've got our depreciation recapture tax, we've got our federal, we've got our Medicare, we've got our state, and they're going to come up with an exact calculation of $192,275. Now, if you're just looking to estimate for your client, the safest thing to do is just say, hey, you're going to pay about a third. All right. 1/3 of this number is going to go to the tax man. And then the CPA is going to crunch a number and get the exact dollar amount, but you're going to be very, very close with your estimate. Now, how many of you are interested in paying the government almost $200,000 when you sell your property? I'm not. Are you? Probably not, right? Well, the good news is you don't have to. The good news is that real estate is the most tax-advantaged investment out there. Real estate has phenomenal tax breaks when you own the property, right? You get to write off your expenses, you get to depreciate the property, you get to write off your interest. But ladies and gentlemen, when you sell real estate, you also have significant tax breaks available to you. And the tax break that you get when you sell property depends on the type of property you sell. Now, there are two tax laws that everybody needs to know when they're selling property, okay? You need to know about Section 1031 of the Internal Revenue Code, and you need to know about Section 121 of the Internal Revenue Code. These two tax laws will come into play on almost every property you list, right? Section 1031 is what I specialize in, and that is the tax deferral of investment property. Section 121 is tax avoidance when you sell your primary residence. All right, these two tax laws are available to you when you sell these two types of properties. You sell a home that you live in, and as long as you have lived in that home for 2 of the past 5 years, you can avoid paying taxes on the first $250,000 of gain if you're single, and the first $500,000 if you're married. You sell a rental home. Well, guess what? You can avoid paying or defer paying all of your tax liability, provided you go out and you do a 1031 exchange. Now, these two tax laws, very important. Tax law for your investment property, tax law for your primary residence. But guess what? There are occasions where you can use these two tax laws together on the sale of one property. Let me give you an example. I have a client who right now is selling a 2-unit building for about $2 million. My client lives in the top unit and she rents out the bottom unit. She's selling that property and she is taking her homeowner's exemption on the value of the top unit, and she's doing a 1031 exchange on the value of the bottom unit that's been rented. Now, it doesn't have to be a 2-unit building, right? It could be a 4-unit building. Your client lives in just one of the units, and then she rents out the other 3. All right, you can use 1031 and 121 in that type of situation as well. I also have a client who's got a big giant farm in the Central Valley. On that farm is a tiny little house. Well, the client, when they sell the farm, they can take the homeowner's exemption on the house. And then there are 60 acres where they graze cattle. Guess what? The 60 acres are business use property, which qualify for 1031. So you sell the farm, you take your homeowner's exemption on the value of the house and the value of the productive land, you get to 1031 exchange. You walk away from all of those transactions paying 0 or next to 0 on the sale because you know how to use the tax law to your advantage. Does that make sense? These two tax laws, ladies and gentlemen, are very important. They're going to come into play in almost every single deal you work on. Now, let me ask you a question. What type of property could you sell that would not qualify for 1031 and it would not qualify for the homeowner's exemption? Let me give you an example of a property that upon sale does not have a tax break. Okay, it's a second home. All right, if you have a second home that you own in Palm Springs, you don't live there, it's not rented out, and you sell it, guess what happens? You pay taxes. So if you have a second home in Palm Springs and you don't want to pay taxes, what do? Well, you move into it and you live there for at least 2 years, or you rent it out. And after you establish it as a rental, you can exchange it. Okay, so there are properties that you can sell that don't have any tax break upon selling, but we can get you to a point where you can qualify if you're smart and you plan appropriately. Now, ladies and gentlemen, before I move on, I do want to make one important distinction between these two tax laws that you're looking at. Section 1031 is tax deferral. Section 121 is tax avoidance. Which one's better? Well, it's always better to avoid paying taxes, right? When you avoid paying taxes, you just don't have to pay them. And there's no requirement what you do with the money. Section 1031, on the other hand, well, there's a requirement, right? We're going to talk about what the requirement is. You got to go out and buy another property. And what you're doing with a 1031 exchange is you're simply deferring taxes. And that's a good thing because you don't have to pay taxes today. But if you stop exchanging, you got to pay your tax bill. Now, let me give you an example of what happens for a lot of our clients. A lot of our clients will start off small. They'll own a 2-unit building, and they'll sell it and do an exchange because they don't want to pay taxes, and they'll go out and buy, a 6-unit building. Client will own the 6-unit building for a while and then sell it, do another exchange into a 10-unit building, sell the 10-unit building, go out and exchange into a large 20-unit apartment building. Now, the great thing about the exchange is my client here has never paid taxes, right? They've been able to build their portfolio up and own this giant apartment building, this 20-unit apartment building in a great location, and they got there by doing a series of exchanges and never paying taxes on any of their transactions. The problem is the client is now at a point where they don't want to manage property. And they call me up and say, well, geez, Leonard, we want to sell this property. I said, okay, well, let's do an exchange. And they say, no. We want to cash out. We're done. We want to wipe our hands clean from real estate. We want to take the money. We want to go buy a boat, vacation, spend time with our grandkids. Okay, you can do that. But the problem with that is if you sell the 20-unit building, you're going to pay taxes on all of the gain from all of your transactions. That's right, ladies and gentlemen. Your gains follow you, right? When you're doing an exchange, you're building a snowball of taxes that's getting bigger and bigger and bigger with every successful transaction. And if you cash out, you got to pay the tax man. Many of you are thinking, well, geez, that stinks. Yeah, it does. So what do? You don't cash out. Here's what many of my clients will do instead of cashing out. They will do another exchange into a property they don't have to manage. And then they will employ the 3 Ds of investing. Okay? The 3D strategy of investing, ladies and gentlemen, is defer, and then die. Just don't sell. Exchange into property that you don't have to manage, live off the passive income, and then kick the bucket. When you pass away, your deferred gains pass away with you. What happens when you pass away, ladies and gentlemen, is your kids, my little annoying 6-year-old and 9-year-old who keep coming into my office, will receive a step up in basis. So in the advanced class today, what we've talked about already is how to calculate your basis. Do you remember that slide? If you've got a low basis and a high sale price, you've got a lot of gain. But guess what? When I kick the bucket, my kids are going to inherit the property and the basis steps up to fair market value. So if my basis is $100,000 and the property is worth $10 million, I've got a ton of gain. $9.9 million of gain. But when I die, that basis steps up to $10 million for Olivia and Sebastian, my kids. They can go out and sell the property the day after my funeral and pay absolutely nothing in capital gains taxes. So what I've done is I have built a fantastic portfolio over my lifetime, and I've passed all of that wealth on to my kids upon my death. The government doesn't get their share. Ladies and gentlemen, that is why the 1031 is so powerful. It is a fantastic wealth building tool, but it is also a great way to pass on wealth to future generations. So, Olivia and Sebastian, you're lucky. Stay out of my office. So, let's talk about 1031. How do you do it? Well, 4 basic guidelines to do in a 1031 exchange. Number 1, properties must qualify. How does a property qualify? Well, it has to be used for business or investment. And Natasha says, well, geez, do short-term rentals count? Absolutely. As long as you are renting a property out for 14 days per year for at least 2 years, you have established it as a rental. However, when you have a short-term rental, you have limitations on your personal use. All right? When you have a short-term rental, you have to limit your personal use to either 14 days per year or 10% of the amount of time the property was rented. So, in order to have a 1031 exchange property, all you have to do is rent it out for 14 days for at least 2 years. So 14 days this year, 14 days next year, and that will work. But you have to limit your personal use to 14 days or 10% of the amount of time the property was rented. So don't use the property too much, Natasha. If you have a property in Tahoe and you like to ski, don't go there for more than 14 days unless you've rented the property out for a lot of time. All right. If you rented the Tahoe property out for 300 days, Natasha, you can use it for 14 days or 10%, whichever is greater. So in that case, you would get to use it for about a month, 30 days. Does that make sense, ladies and gentlemen? The government is going to look at, upon an audit in an exchange, how you use the property, but also your intent. Okay? Did you intend to use it as an investment? Did you try to rent it out? Did you personally use it too much? All of those factors are going to go into deciding whether or not your properties qualified as business or investment properties, and if you can exchange them. Now, I always tell clients, put a tenant in there for 2 years minimum before you do anything else with it. Collect rent every month for 2 years if you can. Report that rental income on your tax filings, and you should be okay if you're ever audited. That's a good way to make sure that you don't have a problem with the IRS. All right, so when you do an exchange, make sure your properties are used for business or investment. Also, when you do an exchange, you have to trade into like-kind property. What does that mean? A lot of people get confused by this. All right, like-kind is very broad. Like-kind is any type of investment or business. So you could sell land and you can exchange into a rental home. You could sell a rental home and buy an apartment building. You could sell an apartment building and buy an office building. You've got a lot of flexibility on the type of property and also the location. You could sell in California and buy in Texas. You can sell in Texas and buy in New Mexico. You can sell in New Mexico and buy in Ohio. Anywhere in the United States will work. The like-kind requirement is only limiting in the sense that you cannot go and exchange into property outside of the United States, and you cannot exchange inventory. All right, inventory is not exchangeable, and when we're talking about real estate, inventory is generally a quick flip or a development deal. So if you've got a flipper for a client, someone who goes out and buys properties, spends 6 months fixing it up, and then flips it, they are not doing exchanges because they have not been seasoned as investments. They're inventory. Now, if you're a flipper and you're thinking, well, geez, that's a bummer, I want to do an exchange. Okay, well, when you're done with your project, put a tenant in there and collect rent from that tenant for 1 or preferably 2 years and then sell it. Because once you've done that, you've seasoned the property as an investment and it will qualify for 1031. Does that make sense? Now, there's all kinds of variations that come up. I get calls every day. What if my client moved in, moved out, Uncle Fred rented it, and then Aunt Sue moved in, but she didn't collect rent? There's a million different what ifs. When you have something that's not clear-cut, this is what I want you to do. I want you to pick up the phone and give me a call. And we will go over the facts and circumstances surrounding the use of your or your client's property, and we'll help you determine whether or not it's going to qualify for an exchange. I've been doing this for about 20 years. There's probably not a scenario that I haven't seen already. So I'm going to be able to get an answer for you, and I'll let you know how risky it is for your client to try to do an exchange. Maybe there's no risk. Maybe there's a little bit. Maybe there's a lot of risk. All right, we'll determine that based off of the facts and circumstances surrounding your particular situation. Rule number 2. When you do a 1031 exchange, if you do not want to pay taxes, I need you to remember 2 things. Number 1, reinvest all of your cash. Number 2, purchase property equal or greater in value. And a lot of people get confused on this. I had a client said to me, well, geez, I'm selling $1 million property. I have $200,000 in profit. So what I want to do is I want to go out and I want to buy a $200,000 1031 exchange property. What do you guys think about that? That doesn't work, okay? Because you're doing neither of these. When you do an exchange, if you sell for a net sales price of $1 million, when you do your exchange, you need to buy replacement property for $1 million or more. All of the cash, after you pay off your debt and your commissions, comes into the 1031 exchange account, and you use that cash as a down payment to buy your $1 million plus property. Now, many of you might be thinking, well, geez, Leonard, I had a loan on the property I'm selling. Okay. Well, what do I do? Well, your loan gets paid off, and when you buy your new property, you're either going to get another loan or you're going to contribute additional cash out of your own pocket, because you need to still buy $1 million worth of real estate. And if you had debt on the sale property, you're going to need to get debt again on the new property unless you want to bring additional cash out of your own pocket. Does that make sense? Okay, when you do the exchange, you need to replace the value of what you sold after commission and closing costs, and you need to use all of the sale proceeds as a down payment. If you do those 2 things, you will defer all of your taxes. Now, what happens if you don't? You sold for $1 million and you found out that the property that you wanted to pay $1 million for just got reduced and you only had to buy it for $950. Well, you're not going to offer more money, right? You're going to buy that property for $950, and because you're trading down in value, what happens? Well, the $50,000 trade down difference is simply taxable. Whenever you trade down in value, it doesn't disqualify the entire exchange. You just pay taxes on the difference. Now, if you don't want to pay taxes on this $50,000, you can go out and you can buy another property, right? So you can do multi-property exchanges. You could sell one and buy 2. That's also possible. I don't know what you're going to get for 50 grand. I don't even think you're going to get a garage in California for 50 grand. Go out to Texas, maybe you'll get a couple acres or a whole house, right? So I do have clients who do multi-property exchanges, sell 1, buy 2. I do have clients who do partial exchanges where they have a little bit of money left over and they pay taxes on it. So you can structure your exchange however you want. All right. But most of my clients, they don't want to pay a dime to the government. And if that's your goal, you need to reinvest all of your cash and you need to purchase property equal or greater in value. Okay, Natasha says, well, what if there's additional funds after your down payment? Okay, I don't know what that means. Are you putting in additional funds? If you need to put in additional funds, you can always do that. You can always add money to your exchange. That's not a problem. All right, so rule number 1, make sure that your properties qualify. Rule number 2, purchase property equal or greater in value and reinvest all your cash. Rule number 3, very important, ladies and gentlemen, get your exchange done on time. When you do a 1031 exchange, you have a total of 180 days to complete the entire process. Your 180-day time frame starts the day you close on the sale property. You got 180 days to go out and buy the replacement property and close on it. Not just get into contract. You have to close on the new property on or before day 180. Now, 180 days, that's about 6 months. So most of my clients do not have a problem with the 6-month requirement. What stresses my clients out more than anything is what they have to do on day 45. Day 45 is very important when you're doing an exchange because that is the day your identification letter is due. Now, what does that mean? Well, on day 45, you have to specify in writing all of the properties you're thinking about buying. And guess what, ladies and gentlemen? You can't go to the MLS and print out a list of 2,000 properties in San Diego and say, hey, I'm going to just buy something in San Diego. It's going to be one of these because this is what's on the market, right? It doesn't work like that, all right? The government gives you rules for how to fill out your identification letter. There are 2 options to filling out this letter over here. Option number 1, you can fill out the letter using the 3-property rule. The 3-property rule, as it sounds, gives you 1, 2, or 3 options. So you can fill out your identification letter on day 45 and you can nominate 3 pieces of real estate that you're going to buy. But guess what? Once you nominate those properties on day 45, you can't change. So on day 46, if property number 1 gets sold to someone else, you can't replace it. On day 47, if property number 2 burns to the ground, you can't replace it. You've got 1 property left on your list, and if you cannot purchase and close on that final property, ladies and gentlemen, you do not have an exchange. And when you don't complete your exchange, you pay taxes. Here is my advice. Do not wait until day 45 to start making offers. When you do your 1031 exchange, you are going to sell a property and you're going to be in escrow usually for 30 days. While you're in escrow back here, before your exchange has even started, you can start making offers. Many of my clients are in contract to buy a property way back here, and then they close on the new property within the first week or 2 of their 1031 exchange time frame. They don't even get to day 45 because they've already purchased their replacement property way back here. That is good planning. Now, it doesn't always work like that, right? But it can. So when you do an exchange, I want you to think about what you might want to buy, and I want you to start thinking about it way back here while you're in escrow on your sale property. Because once you close escrow, those 45 days are going to go really quickly. And you don't want to be in a situation where you nominate 3 properties on day 45 and you can't get any of them. So do your homework, do your due diligence, and you'll have a successful exchange. Now, some of you might be thinking, well, geez, I'm going to sell a property for $1 million in California, and I want to go to Texas, and I want to buy a bunch of $200,000 homes. And I want to buy more than 3. How do I do that? Well, if you want to identify and buy more than 3 properties, you have to nominate those properties on day 45 using the 200% rule. The 200% rule allows you to nominate on your identification letter as many potential properties as you want. Here I've got 6. And that's fine. As I mentioned, you can nominate as many properties. There's no limit on the number of properties, but the 200% rule does limit the value of all those properties. And the value of all these properties cannot exceed 200% of what you sold. Now, pay attention, all right? Remember, I've been saying we've been selling our properties for a net sales price of $1 million, right? So the way I got my net sale price was I got into contract for 1.1. I took $100,000 of commission and closing costs, and then I got my net sale price of $1 million. Okay, and that is important most of the time, except when we're identifying. When we're identifying property and we're using the 200% rule, we're going to take 200% of the top number to get a $2.2 million value for 1031 exchanges. All right? All right. So the 200% is taken off the gross sale price, not the net. Very important, all right? And ladies and gentlemen, there you have it. Those 4 basic requirements are going to get you through almost all the issues in a 1031 exchange. Now there's more, right? And we'll be here to kind of guide you through the other issues. But these are the most common things that you're going to run up against in a 1031 exchange. But let's talk about some other things, all right? Let's talk about this. Because this is the advanced class, I want to talk about how you can convert a rental property into a primary. Now, why would you want to do that? You want to do that because once you have converted your rental to a primary, you can take your homeowner's exemption and avoid paying taxes, right? So we bought this property for $100,000. It's now worth $600,000. We've got about $500,000 of gain in the property, right? So you might be thinking, well, geez, let's move into the property and we'll sell it as our home. And because you're married, you get to take all of the gain tax-free. That's a great strategy, right? It is. But so many people did that the government limited your ability to move into a rental property and take your homeowner's exemption. The government says now that when you move into a rental property, you can only take your homeowner's exemption for the gains associated with the years that you lived there. Let me explain that. Pay attention, guys. How many years have I owned this property? Okay, I've owned it for 4 years. 2 years as a rental and 2 years as a primary. All right, so 4 total years of ownership. 2 of the years were rental and 2 were primary. All right, so 50% of my gain is going to be allocated to my primary residence, and 50% of my gain is going to be allocated to the rental. And when I sell this property, I can only use the homeowner's exemption on the percentage of gain allocated to my primary residence years. Does that make sense? This is advanced stuff, okay? So if you're not following along, don't worry about it. This is kind of advanced. When you do this strategy, converting a rental into a primary, yes, you can take the homeowner's exemption, but only on the gain allocated to the time you lived there. Now, is it advantageous to move into my rental? Absolutely, because you're going to get some of your gains tax-free. Not all of them, because the government changed the rules and they prorate the gains between these 2 use periods. Does that make sense? Okay, Let's move on because I've got some more advanced strategies for you. Check this out. How about, ladies and gentlemen, we do the opposite? We have a home that we've lived in for 20 years. We bought it for $100,000. We're selling it for $1 million, or it's worth $1 million. So we have $900,000 of gain. If we sell this home, we get to take our homeowner's exemption, but guess what? We have too much gain because only $500,000 for married couples can be exempt. The problem is that leaves us with excess gain of $400,000 that's going to be taxable. So you sell your highly appreciated primary residence in this situation and you owe $100,000 in taxes. So what do? Well, this is what I like to tell people to do. Don't sell it as a primary residence. Move out. Convert the property to a rental. Establish that property as a rental for at least 2 years so that when you sell it, you can do what? You can take the 1031. Now, here is the beautiful part of this strategy, ladies and gentlemen. If you have converted your primary residence into a rental and you've established it as a rental for 2 years, you can take the 1031 exchange when you sell it. But because you've also lived in the property for 2 out of the past 5 years, you are also eligible for the homeowner's exemption. So when you sell this property, you have 2 tax laws that you can take advantage of. Both the 1031 and the homeowner's exemption apply. And you can sell this property and pay absolutely nothing in tax liability. Here's how it works. All right? You're going to sell this property after renting it out for 2 years. You're going to sell it for $1 million, $1 million. Because you've lived in it for 2 of the past 5 years, the first $500,000 of gain comes out tax-free. The remaining value is going to be allocated to the 1031, and as long as you do an 1031 exchange and go out and buy another $500,000 worth of rental property, you will defer paying taxes on all of the excess gain. This, ladies and gentlemen, is a phenomenal gift that the government gave us several years ago. They said that yes, if you are eligible for the 1031 and the homeowner's exemption, after you've converted your primary to a rental, you can take both. You don't have to pick one or the other. You can take both. This little nuance to the tax law has saved my clients hundreds of thousands of dollars. So, convert the primary into a rental and take both the homeowner's exemption and the 1031. That is an advanced strategy that, again, saves clients hundreds of thousands of dollars in taxes. Okay, let's move on. What else am I going to talk about? The reverse exchange, real quickly. Don't like them. They're a pain in the butt. But a lot of people right now want to do them. What is a reverse exchange? Well, it's a 1031 exchange, but in reverse. So instead of selling a property and buying, you do the opposite. You buy first, and then you sell. Now, let's talk about that. Reverse exchange allows you to buy your new property today, and as long as you sell your property within 180 days, this sale will be tax deferred. The problem with a reverse exchange is that you cannot own the new property and the old property at the same time. So in a reverse exchange, my company is going to take title to the new one for you. We will own the property until you get yours sold. Once you sell this property, we will transfer the new one to you. So reverse exchange, we simply buy the property for you until you get yours sold. But guess what, ladies and gentlemen? We don't use our own money to buy this for you. You still have to pay for it. And if you need to get a loan to buy this property, it is going to be very difficult because lenders do not like loaning on reverse exchanges. When they loan you money, they want you to take title, not the exchange company. So reverse exchanges are challenging because financing them is very difficult. There's also transfer taxes that you have to pay twice. There's escrow and title fees that you have to pay twice. Our fee is higher. So reverse exchanges are complex and more expensive. But they are possible. So we do them, but it has to be the right client with the right lender. Or it has to be an all-cash purchase, no lender involved. So can a reverse exchange happen? Absolutely. Do I recommend them? No. I generally advise people to avoid reverse exchanges if they can. And if you can't avoid the reverse, well then yeah, we can get it done for you. All right. All right. Ladies and gentlemen, I think I talked about most of these things. What I want to do is I want to skip some of the advertising I was going to do and just go to the questions that you have. Now, one of the most important things that I think you could take away from today's class is this right here. Okay, this is my phone number. You're going to think, well, geez, I know this stuff really good now, right? Leonard did a good job explaining it to me. It makes sense. And then you're going to go home and you're going to forget. And then your client's going to ask you and you're going to say, oh, I thought I knew that. Well, don't try to explain to the client something that you only know 50%. Okay, pick up the phone, do a conference call with myself or anyone on my team here, and make sure that you get the right information to your client so that they can make the best information based off the best, I don't know what I'm saying. Give us a call, right? Give us a call when your clients have questions, when you need to go over this stuff, right? So put my phone number in your cell phone, add me to your email contacts list, and use us as a resource. Now, with that said, I've got a ton of questions that have popped up here on my computer screen. So let's go ahead and scroll through them and use our last few minutes here to get everybody's questions answered. So Joe says, after 27 and a half years of depreciation write-offs, what does the tax rate become? Well, depreciation shelters your rental income from taxes. So your rental income is taxed at ordinary income rates, and the tax rate doesn't change. You just have more rental income to pay taxes on now because your depreciation's gone. Natasha says, I have a 1031, no debt, $400,000 into a $1 million property. Down payment is $200. What about the additional $200 from the first property? You need to put $400 down. Okay? So Natasha asked a question that a lot of people get confused on. Okay, she sold property for $400,000. She has $400,000 sitting in the 1031 exchange account. She's buying $1 million property, and her lender says, well, geez, just put 20% down. No, she's doing an exchange. Natasha needs to put $400,000 down. Otherwise, she has boot. She's got money left over. And unless she goes out and buys a second property with that, Natasha's got a problem. Don't let your lender screw up your 1031 exchange by telling you to put less down. You need to put all of the cash in your exchange account down on the new property. All right, Antonia says, if you identify, then sell your property and the identified property goes into contract, is there a normal 1031 time frame sellers are willing to wait for? Everything is negotiable, right? So if you are trying to sell your property and you want a long escrow to stretch out your 1031 time frame, negotiate with a buyer. On the flip side, if you found a new property to buy and you haven't sold yours yet and you don't want to do or can't do a reverse exchange, ask the seller of the property you want to buy for a long escrow so that you can get your property sold. Everything's negotiable, right? So if you want to try to go for a 90-day escrow, go for it. Another question. If you complete your exchange and buy your new property before day 45, do you still have to send in the identification letter? No, you're done. Unless you're going to buy a second property, you're done. So Antonia says, well, she sold for $475,000. She wants to buy for $1.4 million. Does that work? Absolutely. You can always go up in value. You can go up as high as your purchasing power will allow you. If you sell for $475,000 and you want to buy for $20 million, go for it. Can I get a copy of your presentation today? Absolutely. Everyone's going to get an email later this afternoon with a copy of the presentation. This presentation will also be loaded on YouTube, and you can go and listen to me at your leisure anytime in the future. Can I get into gifting my property to my kids? No, don't do it, Gabby. The worst thing you can do is gift your property to your kids. And the reason why is because then you are gifting all of your tax bill to them. Don't ever gift real estate to your kids, Gabby, or anyone else. Just die. Just set up a trust and make sure your kids inherit your property when you die, because the great thing about dying is that your tax bill dies with you. So do not gift property to your kids. And end of story. Joan established a property as a rental for 1 year, and then she moved into it. And she wants to exchange it now. Can't do it, Joan. The property has to be a rental at the time of sale. Okay, it doesn't matter what you did with it last year, 2 years, 20 years ago. 2 years leading up to the sale, the property needs to be rented in order for it to qualify for 1031. Antonia wants to know if you can buy with a partner. Absolutely. Here's how buying with a partner works. You sold a property for $500,000. You need to own $500,000 worth of the new property. So if you're buying $1 million property with a partner, you can each own 50%. Now, if you sold a property for $500,000 and you're going to buy a $2 million property with a partner, all you need to own is $500,000 worth of it, or 25%. Now, you could own more, but you don't have to. Whenever you do an exchange, you need to replace the value of what you sold. And if you do that and you have a partner, you better make sure that your ownership is equal or greater to what you sold. Does that make sense? Gabby's asking a lot of questions. Gabby says, I have a client that wants the 1031 to give his daughter her inheritance to help her buy a house right now. Okay, so this is how that's going to work. Okay, your client's going to sell, let's just call it $1 million property, and he wants to buy a $1.5 million property for his daughter to live in. The client needs to own $1 million worth of it, all right? And he needs to rent this part out to his daughter who is living in it. The daughter can own this part, but my client, the exchanger, your client, needs to own a percentage of this property. What is that? 75% of the property. and he needs to collect rent from his daughter because it needs to be an investment for him. So yes, he can buy with his daughter who lives in the building, but your client, the exchanger, needs to own a percentage of this property worth what he sold, and he needs to collect rent for that percentage. So people do this all the time. They think they can use their 1031 funds to help their kids buy a home. And yes, you can, but it does need to be a rental for you. So when your kid moves in, you got to charge him rent for the percentage of the property that you own. If you don't do that, it's not an investment. So you got to be very careful. Mark just jumped on the call and he said, hey, are you going to repeat this? No. I'm going to record it and we're going to post it on YouTube, and you can listen to the whole thing on YouTube. Gabby, the daughter wants to be on title. That's fine. Yeah, the daughter can be on title. Elaine says, can you discuss exchanging into DSTs? Absolutely. A DST is a way to buy into a $50 million or $100 million building. Now, I can't go out and buy a $100 million or $50 million building on my own, but through a DST, I can own a percentage, a little slice of the property. So if I sell for $500,000, I can own a little slice, 1% of this building. And the way I do it is through a DST. And there are companies that specialize in these. And if you're interested in DSTs, I can send you a contact that can explain all of the ins and outs much, much, much better than I can. All right. One more question, please. No more questions. I got to go get my kids homeschooled. I don't know if you saw, but my kids came in here and they were so annoying. And then they went away. And I was like, oh, this is fantastic. They're gone. And then they both came in, and I had to put it on mute and scream at them. So I hope you guys didn't hear that. All right, Latasha says, in the earlier example, confirm using the personal $500,000 exemption and the 1031. Ooh, I can't go through that again, Latasha. That's going to take too long. But what I can do is I can send you an article, and I can also send you a video. All right? So ladies and gentlemen, thank you very much for attending, and I'm sorry that I had to cut Latasha off there, but you will get an answer to that. It's just not going to be right now because we need to move on. It's already 2:10. So thank you all very much. I look forward to everybody doing business with each other here, and I look forward to helping you guys out on your next 1031. And I know, I'm not supposed to scream at my kids, but it's tough. All right, take care, everyone. Have a great day.